Module 4, Analyzing Statements of Cash Flows, number 1. Now, even though it's number 1, this is not the first you've seen of cash flows because there was a reading in the pre-reading section on cash flow statements. So you're approaching this module having already seen a direct cash flow statement, an indirect cash flow statement, and knowing what's in there. If you don't know that, you need to go back and do the pre-read before you hit this learning module. But if you have, let's go, because we're going to build on that knowledge of what the cash flow statement is and see how we can put one together. Starting with this first learning outcome statement, describe how the cash flow statement is linked to the income statement and the balance sheet. And we can do that with a simple diagram from the curriculum and then a few examples. Here is the diagram from the curriculum. And it's fairly simplistic, but it just proves, I think, a nice point. Let's start on the left with the balance sheet. Remember, the balance sheet is at a point in time. Again, something you've seen in the pre-reads. So 12/31/X1, this is the balance sheet at the start of the year. It will show you your position. It is cumulative. For example, and this seems a sensible example to use given where we are, it will show you your cash balance. Maybe it's 500. Balance sheet at the end of the year. Another point in time, again, shows you your position, perhaps cash at the end of the year is 750. In the middle are your flow statements, as we call them, the income statement, the cash flow statement, and the statement of shareholders' equity. We're really interested in this reading in the income statement and the cash flow statement. Obviously, we're going to put the cash flow statement together. That is going to tell you the movement in cash. It will break down where this 250 came from. We can't pick that up directly from the income statement because the income statement is on an accruals basis. It doesn't show you cash flows necessarily. It shows you accruals-based flows. As a good example, we've already seen, if you've been through these learning modules in order, in learning module 1 in the income statement, how to calculate revenue. We know revenue goes through the income statement. Let's say it's 100 as it is earned. The problem is that might not be cash. We earned the revenue, but have we been paid? So we can't track our cash from the income statement because it's on the accruals basis. However, we can combine the income statement and the balance sheets to tell us what happened to cash. Because if that revenue of 100 that went into the income statement was not paid in cash, well, we have accounts receivable. So at the year end, we'd be able to pick up that accounts receivable increased by 100. And we'd say, okay, if I had 100 of revenue, but 100 went into accounts receivable, I have received no cash. That's the link between these statements. And that's really what we're going to do in these exercises and what you'll be expected to understand potentially in exam questions, that we can use the balance sheets and the income statement to work out our cash flow position. Less so the statement of shareholders' equity. That will reconcile for you equity at the start to equity at the end of the year, obviously. Common stock, retained earnings, dividends will be in there. So the only time we'll really see the statement of shareholders' equity is when we're trying to calculate dividends in cash flow from financing later on. Let's do some examples. First up, we have an example on purchases and sales made on credit. And you can see what we're doing here. We're walking through the link between the balance sheet, the income statement, and the statement of cash flows, seeing how each transaction affects one or the other, or all three, or none, and so on. So let's just walk through this one in a little bit of detail, and then we'll get a bit quicker as we look at the next few. What happens here? On the 1st of Jan, we purchase €100 of inventory on credit. It's on credit. So there's no cash impact. No CFO. Purchases, sales are going to go through cash flow from operations. Again, this is the kind of thing you would know from the pre-read. But haven't paid for it yet, so it doesn't go into cash flow. However, it has changed our position. Look on the balance sheet. We now have 100 of inventory, and we owe somebody the cash for that inventory. We haven't paid yet. Therefore, we have to show an accounts payable figure. Notice an asset here and a liability, both of 100, equal and opposite, the dual effect. You always get two equal and opposite impacts from an accounting transaction. So in terms of the linkages between the statements, yes, we made a purchase of inventory. It went up by 100. Why do we not see it in the cash flow statement? Why does it look like zero cash? Because we still owe it, and you can pick that up from accounts payable. What happens next? 31st of Jan, we do pay cash. We pay for the inventory cash. So you'll see $100 as an outflow in CFO. How does that link to our statements? Again, it changes our position. On the balance sheet, we no longer owe $100. We've paid it off. We can remove that 100 accounts payable. However, it cost us. Our cash position drops by 100. 1st of Feb, things get interesting. The inventory gets sold. We sell the inventory for euro 150 on credit. First thing to say, we have given our customer credit, so we received no cash. Nothing hits the cash flow statement. But we've made a sale of the inventory. We have to remove the inventory. Our position on the balance sheet changes. Remove that 100 of inventory. There it was. It's gone. Now, we didn't get cash, but somebody owes us the cash. So we create an accounts receivable, an asset, to show that a customer owes us. How much do they owe us? 150. We have removed an asset of 100 from the balance sheet and replaced it with an asset of 150. At the moment, that balance sheet does not balance. It's just a sheet. Where does the other 50 go? We purchased the inventory with 100. We sold it for 150. We've made a profit of 50. For the first time, we'll hit the income statement. So for a sale, we'll recognize revenue. We've earned it because we've sold it of 150. But we will match the expense, the inventory of 100, by putting that into cost of sales. That will give us a profit of 50, which will sit in equity, which will make the balance sheet balance. And finally, 15th of Feb, the customer pays 150 euro. That is very definitely cash. Cash position on the balance sheet increases. We see it in CFO. The other side in the balance sheet, we no longer owe, or rather, I should say, we are no longer owed by our customer, so we remove the accounts receivable asset. That's it. That's all there is to it. Let's do another one. Depreciation. Bit quicker this. On the 1st of Jan, we own equipment, so it's sat there. We're not buying it. It's just there. It cost at some point in the past 100. So it is sat on the balance sheet as PPE. Depreciation for the year is 10. Now, I'm not putting it in the income statement here because we're going to charge depreciation in one transaction at the end of the year. So it's not an error. We've not put it in yet. We're going to put it all in at the end. On the 1st of July, we buy equipment for cash. That's cash of 200. We'll get a 200 boost to PPE. $200 will disappear from the balance sheet. We'll see $200 as an outflow in CFI, cash flow from investing, because we're buying assets. Depreciation for the year on that asset will be 50. But be careful. We bought it on the 1st of July, so we only need to charge half the year this year. It will be 25. At the end of the year, we charge depreciation expense. How much? 10 on the asset that was there all year, 25 on the asset we purchased, 35 is depreciation expense. On the balance sheet, we add that to our accumulated depreciation balance. That is a contra account. It nets off the historic cost of PPE. We will charge 35 as an expense to the income statement. But, and this is the whole point of this example being here, no impact on CFI. Why? Depreciation expense is not cash. You are going to see it throughout the CF cash flow readings as the classic example of a non-cash charge. It hit the income statement because we were matching the cost of an asset to the revenues it earns, spreading the cost of that asset over its life, but it's not cash. It didn't turn up in the cash flow statement. Next one, borrowing. What happens here? 31st of March, we borrow $500. That's very much cash. We've borrowed it. It's an inflow into my cash flow statement. It will show up in CFF, cash flow from financing. However, when we borrow, we don't see anything turn up in the income statement. Interest expense will be charged to the income statement, but the capital that we borrow does not. It sits on the balance sheet. It will increase our cash position, and we'll have to show the fact that we owe $500 as a loan. And very simple, this on the 30th of September, we repay it. We repay the $500 that we borrowed plus 25 in interest. In the balance sheet, 525 of cash disappears. We reduce the loan to 0. We've paid it off. Our position is updated. In the income statement, you can see there's a difference between these two. Again, the balance sheet wouldn't balance. We have an expense. 25 interest expense goes to the income statement. In the cash flow statement, we see both. The 500 principal repayment was cash. That's an outflow. It's an outflow in cash flow from financing because we are paying off our principal. The 25 interest was also cash, also an outflow. Whereabouts? There's a choice. We'll talk about that right at the end of this module. It might be CFO, it might be CFF, depending on your accounting standards. But the key point, all 525 went through the statement of cash flows, only 25 went to interest expense. And finally, deferred revenue. A company agrees to manufacture a custom piece of equipment for a customer for USD 1,000. Now, I've written out the positions here and the income statement and cash flows, but clearly nothing happens there. It was just an agreement. 1st of October, things kick off. The customer makes a down payment of $300 US. That's cash. Because it's cash, it has to go into the statement of cash flows. Because it's generated from sales, it goes into CFO, cash flow from operations. And because our balance sheet shows us our position, we add it to cash in the balance sheet. However, we do not take it to the income statement because it is not yet earned. We cannot recognize revenue we have not yet earned. This is an advanced payment. What do we need to do? Reflect the fact that we have not yet performed our obligation We have not yet manufactured the equipment. So if the world were to come to a stop today, I would have to give that $300 cash back. Therefore, we put it on the balance sheet as a liability. It's called deferred revenue, showing that I still owe the customer that $300 until I perform my obligation. Now that's probably the most interesting of all of these transactions. What a lot of people do is get on top of deferred revenue and think, I know this. We received a payment. We haven't yet earned the revenue. It's not going into my accounts. Not quite right. You've got the cash. You have to record the cash. The other side, to keep it out of the income statement, is recorded as a liability. Now, on the 30th of November, equipment delivered. So we have performed our obligation. The balance is paid. That's cash. How much cash? It was 1,000. We had 300. So I think an extra 700 comes in on that date. In the balance sheet, we'll add in 700. We no longer have a liability for this down payment. We will remove that liability. And all 1,000, see the difference between those two, 700 boosting an asset, 300 reduction in liability. All 1,000 goes through as revenue when we earned it. A few examples there of how these balance sheets, income statement, statement of cash flows tie together. What the curriculum is trying to do here is get into your head how you can see if a cash flow doesn't happen, yet income statement balances did, the difference staying on the balance sheet. So for example here, only 700 in cash, revenue is 1,000. What happened? We already had the 300 back here. That technique is going to help when we try to put cash flow statements together. And putting cash flow statement together is what we're going to do right now. Our next LOS, describe the steps in the preparation of direct and indirect cash flow statements, including how cash flows can be computed using income statement and balance sheet data. That is what that early LOS was prepping us for. Let us begin. Direct method, first of all. You've seen this in the pre-read, so we don't need to dwell on what it looks like too long, but just as a reminder, the direct presentation lists out cash flows by type to calculate CFO. Direct versus indirect method is only relevant to CFO. CFF, CFI, always calculated and shown in the same way. But CFO, you can calculate, you can disclose in two ways, direct and indirect. The most common presentation is indirect. That's what most companies do. Most companies see that most other companies use the indirect method, so they use the indirect method. But direct can be constructed using the income statement and opening and closing balance sheets. And there'll be a little LOS later on, which will just revisit this and say, yeah, as we said earlier, remember, we can construct a direct cash flow even if we don't have it. How? Well, we're going to walk through it. Few examples to put together an entire direct CFO. Here's the first example, cash received from customers. So the way to think about this, we're going down the income statement and we're trying to get every single line on the income statement as cash. First line you'll see on the income statement, revenue. As we discussed in that linkages LOS, revenue is not necessarily cash. So if we want to find out cash received from customers, yes, we'll need revenue from the income statement, but to check whether or not that revenue was received as cash, we will also need to check accounts receivable from the balance sheet. Here's an example. Imagine 2017, we had $957 on the balance sheet in accounts receivable. 2018, that was $1,012. You can see over the year, there's been an increase of 55 in accounts receivable. In the income statement, revenue for the year in 2018 was $23,598. Now, how do we turn that $23,598 into what we're looking for, which is cash received from customers. Well, you can see the short way of doing it here. Take the revenue from the income statement, 23,598, and deduct the increase in accounts receivable. That gives you 23,543. How does that work? Like this. Going the long way around, think back to that linkages diagram from the first LOS. Take the balance sheet from the start of the year and check your accounts receivable. It was 957. Customers owed us 957. Then check the income statement for the year. What's revenue? 23,598. If you add those two together, you get 24,555. And just pause there for a moment. Customers owed us 957 at the start of the year. We've earned revenue of 23,598 during the year. So in total, they now owe us 24,555. So I'd call that, it's not a balance in the accounts, but I just note that in my head as that's what customers owed me. 24,555 in total from last year and this year's revenue. What's still there on the balance sheet at the end of the year? What's still in accounts receivable? Now, just to make an extreme example out of this, let's say it was 24,555. Well, in that case, what did my customers pay me? Nothing. They owed me 24,555 and it's all still there on the balance sheet. Well, pleasingly, that's not the case here. At the year end, there is only 1,012 left on the balance sheet at the year end. They've paid off everything except 1,012. So 24,555 less 1,012, 23,543. That is the cash that my customers paid me. Clearly, that's a quite long-winded way of doing it. We'd rather do it quicker. Hence, we do it this way. All you need to do is take that beginning balance, compare it to that ending balance, and adjust for the difference. If accounts receivable have increased, you deduct, and that's a good rule. It's an increase in accounts receivable, but being more general, it's an increase in an asset balance. And if you have an increase in an asset balance, you deduct that from your income statement, your accruals-based figure, to get your cash. Cash received from customers done. Keep going down the income statement, you'll get into expenses. And we'll have to try and work out the cash we've paid to our employees, to our suppliers, to others. Let's check it out. First one we'll try and calculate. Cash paid to suppliers. What do we need to check? From the income statement, cost of goods sold. Find out what your COGS is. But that is on an accruals basis. So go and check the balance sheet. If we have purchased goods for resale that we subsequently sold, but we haven't paid for them, that'll be sat in accounts payable, showing what we owe, as in our first example from earlier. But secondly, not everything we bought from our suppliers has gone into COGS. Remember, we must match our expenses to revenues. Only the inventory we sold during the year has gone to the income statement. What about the inventory we paid for but didn't sell? That will be sat on the balance sheet. So we need to check both accounts payable and inventory. Here's our example. 2017 to 2018 again. We have the balance sheet balances for inventory and accounts payable. Inventory increased, as did accounts payable. And we have our cost of goods sold from the income statement of 11,456. That's our starting point, 11,456. Now notice here, these are expenses. They're going to be outflows, so I like to work in brackets, in parentheses, to show it's an outflow. Works better in my head. It looks like on an accruals basis, there was an expense of 11,456. However, that's cost of goods sold. It is not purchases. It's not the amount of inventory I purchased. To get that, what we'll do is adjust for the movement in inventory. Inventory here increased by 707. That once again is an increase in an asset. Because it's an increase in an asset, we deduct it. It's already an outflow of 11,456 in brackets, in parentheses. If we deduct another 707, that tells us we actually purchased 12,163. That doesn't sit right in your head. Very quickly, let's look at the long way. Cost of goods sold is made up of your opening inventory, your purchases, less your ending inventory. Now, from the balance sheet, 3277 was in the balance sheet in your warehouse at the start of the year. Ending inventory, 3984 was still there at the end of the year. And my cost of goods sold was 11,456. If I take my opening plus my purchases less my ending, that must tell me my COGS. You can work backwards and balance to purchases of 12,163. Once again, that's a long way around. It's much quicker just to take the difference in those two inventory balances. So we've got as far as purchases 12,163. We haven't necessarily paid for those purchases though, and if we haven't, it will show up in accounts payable. Accounts payable increased by 263. That is actually an increase in a liability. And if we have an increase and a liability, we get to add it back. Looks like an outflow of 12,163. Add back 263. The cash paid was 11,900. Logic for that. Accounts payable at the start of the year, I owed my suppliers 3,325. Purchases, 12,163. If I hadn't paid anything at all, I'd still owe them 15,488. Everything from the start of the year plus this year's purchases. I have paid something because I only owe them at the year end. Accounts payable at the year end, 3,588. Therefore, I must have paid 11,900. Cash paid to suppliers. Next up, cash paid to employees. Very simple this. In the income statement, you'll see salary and wages expenses. If we haven't paid, you'll see salary and wages payable on the balance sheet. So you'll check your balance sheet balances. You can see in our example from 2017 to 2018, salary and wages payable, which remember, because it's payable, is a liability, increased by 10. In the income statement, the expense was 4,123. So let's get a bit quicker about this. 4,123 expense. I'm showing it as an outflow in brackets in parentheses because it's an expense. We had an increase in the amount we owed. An increase in a liability. An increase in a liability I get to add back. That is $10 of this year's expense that I haven't paid. Add back the 10, it's 4,113. The long way round, what did I owe at the start of the year? 75. The expense for the year, 4,123. Add those together, 4,198. I still owe at the end 85. I must have paid 4113. Should be getting good at this by now. Very similar example coming up next. It's cash paid for other operating expenses. So we'll look on the income statement at other operating expenses, but be careful. 2 line items to check out on the balance sheet: prepaid expenses and accrued liabilities. What are these? Well, a prepaid expense, clue is in the name. If at a point in time you see a prepayment, it's an expense for the future, which we paid already. We prepaid it. If at a point in time you see an accrued liability, it is an expense already incurred, but not yet paid. So very much like accounts payable, the difference, often you're having to estimate what that liability is. It may be your electricity invoice for the final quarter. You haven't received it when you put your accounts together. Prepayments are common for things like insurance and rent. You pay in advance. Now you can see that this is an issue because the cash payment is not matching the expense. For prepayments, already been paid, but expense is not till the future, so it won't show up in the income statement. Accrual is in the income statement, but you've not yet paid. Let's look at an example, 2017 to 18 again. We have prepaid expenses going from 178 to 155, a decrease of 23. A prepayment is an asset because you've prepaid. If the world stopped right now, you haven't yet used the building for that rent. You haven't yet made use of the insurance. You get your cash back. Accrued liabilities, clue very much in the name. It's a liability. You've used up the expense or the goods, whatever it was, to incur the expense, but you haven't paid it. That increased by 22. And from the income statement, our other operating expenses were 3577. That's our starting point. Again, it's an outflow, so in brackets, in parentheses, 3577. Prepaid expenses, an asset, decreased. We've seen already that an increase in an asset gets deducted. A decrease in an asset gets added back. So we take this decrease of 23 in prepayments and we get to add that 23 back. Why is that? Well, let's focus on that 178. That 178 from the start of the year, that prepayment was paid last year, but charged to this year's income statement. It was last year that we made the cash payment, but it was for a future expense. So it's dropped into the income statement. It's part of these expenses, but it's not something we've paid. We get to add it back. At the end of the year 2018, the bad news, that 155, because it's a prepayment at the end of the year, it relates to an expense in the future. It is not part of that 3577, but we have paid it. We have to deduct it. Add back the opening, deduct the ending. The net effect is to add in the 23 when it decreased over the year. Liabilities, an increase of 22. We've seen this rule before. An increase in a liability, we get to add back. 1104 at the start of the year, 1126 at the end. Similar logic to your prepayments. The 1104 from the start of the year, that was accrued from last year. It was last year's expense. So it's not part of this 3577, but we are going to pay it. Therefore, it needs deducting. The 1126 at the end of the year is accrued at the end of the year. It is part of the 3577, but because it's accrued, we haven't yet paid it. We get to add it back. Deduct the opening balance, add back the ending, because the ending was higher, because it increased. I get to add back the net amount. Cash paid for other operating expenses is therefore 3532. That's probably the longest and the trickiest one to look at. Couple more to finish off. Cash paid for interest. On the balance sheet, it'll be interest payable. In the income statement, interest expense. Fairly straightforward. Let's rip through this. On the balance sheet, 2017 to 18, 74 to 62, it decreased by 12. That is a liability. It's a decrease in a liability. That needs deducting. That's our final rule. Decrease in a liability. Not only have we paid off this year's expense of 246, we've also paid some that was outstanding from last year. If you wanted to do it very quickly, at the start of the year, I owed 74, expense 246. Add those two together, we have 320. I'd still owe 320 if I paid nothing. At the end of the year, what do I owe? Only 62. I only owe 62. Must have paid 258. Cash paid for interest. Final one. Right down at the bottom of the income statement, cash paid for income taxes. We can pick up income tax expense from the income statement and income tax payable on the balance sheet. Pretty straightforward here. We're not playing around with any deferred tax, anything like that. When we get to the deferred tax reading, you'll see this could be a little bit more complicated. But for the moment, expense suggests it's 1139 as an outflow, but we can see an increase in what we owe the tax authorities. That's an increase in a liability, suggesting some of this has not been paid, so we get to add back that increase. And cash taxes paid look like only 1134. That's the direct method finished. To recap, go through every line in the income statement, pick it from the income statement, check the balance sheet to see how much of it was accruals based, make your adjustment, and get back to the cash. Let's move on to the indirect. What does the indirect method look like? Again, we saw it in the pre-read. Instead of listing out cash flows directly by type, CFO is calculated by adjusting net income. So at the top of a cash flow statement prepared using the indirect method, you'll see net income reconciled down to CFO. How do you reconcile it? Two things you must adjust for. Non-cash items. Why adjust for non-cash items in a cash flow statement? Should be fairly self-explanatory. They're not cash. They don't belong there. Secondly, changes in operating working capital items. That is exactly what we were doing in the direct method, adjusting for the accruals element. So there are really two issues. Some items that are just not cash at all, they need adjusting. And secondly, items that have some cash and some accruals in them. A couple of examples. Revenue. Revenue has some cash in it, hopefully, but some accruals. So you'd adjust your revenue for accounts receivable. We've already seen that. But some items are not cash at all. Now you might be asking, all right, well, what did we do with those non-cash items in the direct method? Well, we completely ignored them, because all we were doing in the direct method was listing out cash flows. The problem with the indirect method is we are starting with net income. And that net income figure includes non-cash items. That's why we have to adjust them here, but did not have to worry about them in the direct method. What type of thing might we adjust for? Well, there is a dizzying array, as you can see here. Let's just pick out the common ones. The absolute classic non-cash charge is depreciation and or amortization expense. We saw it in a transaction earlier in our linkages. It is charged as an expense. Because it's charged as an expense, it reduces net income. But it's not cash. If it brings net income down but it's not cash, we need to add it back to get back to our cash flow. Hence, it's under the additions heading. Depletion expense of natural resources is exactly the same concept. Amortization of bond discount. More from your pre-reading. Remember, when you account for bonds, if a bond is issued at a discount, the problem is your coupon interest paid does not equal your interest expense. What we want in the cash flow statement is the cash, the coupon dollars paid. We'll have to take the difference between the interest expense and the coupon and adjust for it. That difference is known as the amortization. When we issue a bond at a discount, what will actually happen, to be precise about it, is your coupon will be less than your interest expense, because your interest expense includes the dollar coupon payment and the amortization. All of this has reduced net income. This amount is not a cash charge. It gets added back. The exact opposite is true for bonds issued at a premium. The amortization of a bond premium reduces interest expense. Therefore, it needs subtracting. Loss on sale or write-down of assets. An impairment, you'll see that in long-lived assets, or a loss on sale, both non-cash, but both reduce net income. They must be added back. Loss on retirement of debt, same thing. Not cash, reduces net income, must be added back. And the opposite is a gain on sale of assets. Loss on sale is added back. Gain on sale, subtracted. It's not cash, but if it's a gain, it has increased net income. Loss on retirement of debt. Again, it's an accounting loss. It has reduced net income, but it's not a cash flow. The payment is the cash flow. Over here, the opposite, gain on retirement of debt. The gain is not a cash flow. It's what you paid. It's what you want in cash. The gain has boosted net income, but is not a cash flow. Now, investments held under the equity method. Group accounts, it's level 2. So it's in here so you're aware of it as an analyst in a set of group accounts. If you have significant influence, over another entity, you will bring a share of their results into your accounts, despite the fact they may have paid you no cash at all. If you own 20% of them, let's say first off they made a profit of 100, you own 20%, you will bring $20 into your income statement, despite the fact they paid you no cash. If it's income, it increased net income, you must deduct it. If you bring in a share of their loss that reduced your net income, you can add it back. Now, because that's a level 2 group issue, as I say, I don't think we'll get numbers on this, but you need to be aware of it, and it's just more practice on understanding the link between cash, non-cash, net income, and CFO. Deferred tax. We have an entire reading on deferred tax liabilities, so will become crystal clear once you've been through that module, hopefully. An increase in a deferred tax income liability. That results if you increase your liability in a charge to the income statement. It's not actual tax. It's nothing you paid, but it reduces net income. Therefore, it's added back. If it decreases, you get a credit to your tax expense. That increases net income. You must subtract it. And finally, everything we were dealing with in the direct method. Increases and decreases in our assets and liabilities. And here are the rules that we learned as we went along in the direct method. Whether we add or deduct increases or decreases in assets and liabilities, we've already learned all of these. Now that was a bit much, a lot to take in one page, so let's actually see it in action. Here is an indirect example. And we'll see how you can very easily put it together with just those basic rules that we learned. Remember the point of an indirect cash flow, its starting point is net income. So we'll go to the income statement and we will pick out net income, 2210. So there is our 2210. We must adjust for two things, non-cash items and changes in our operating assets. First of all, let's see if we can find any non-cash items. Revenue, well, hopefully there's some cash in there. Gross profit, that is just a subtotal. I'm just putting a gentle line through it so I don't accidentally include it as an adjustment. Salary and wage expenses, well, hopefully there's some cash in there. It'd be nice if there wasn't, but there'd be a revolt. Depreciation expense. There you go. Depreciation, we said, was your classic non-cash charge. 1052. 1052. Add it back. It reduced net income. It is not a cash outflow. Other operating expenses, 3577. There should be some cash in there. Total. Well, that's just a subtotal again. Operating profit. Subtotal again. Other revenues and expenses. Gain on sale of equipment. Non-cash. The proceeds on sale of equipment. Now those proceeds represent cash, but they will be in CFI, not CFO. The gain is not cash because it's a gain. It has increased net income. It needs to be deducted. We deduct that 205. Interest expense, I would assume there's some cash in there. The 41 again is just a subtotal. Income before tax subtotal. Income tax expense should have some cash. I think I'm done. So here, I have adjusted for my non-cash items. After that, it is exactly what we did in the direct method. And we were actually using this example in the direct method, the same numbers. So you might recognize them. Let's go through and adjust for our operating assets. What I tend to do when I put these things together is just check line by line on the income statement and go and find it on the balance sheet. So let's start with revenue. 23,598. Some of it's cash. If it's not cash, it's going to show up from revenue into accounts receivable. Change was an increase of 55. Remember from the direct, increase in an asset is deducted. Cost of goods sold is next, 11,456. We'd need to check inventory and accounts payable. Increase in inventory of 707, an increase in an asset, deducted. Increase in accounts payable 263, increase in a liability, added back. Keep going down the income statement, salary and wage expense. 4123, do we see anything on the balance sheet? There you go. Salary and wage payable increased by 10. Increase in a liability. Add it back. What else do we have? We've done salaries, depreciation we already dealt with. Other operating expenses. Anything on the balance sheet? Well, we need to look out for prepayments and other accrued liabilities. Prepayments decreased by 23, a decrease in an asset added back. Other accrued liabilities increased by 22, increase in a liability, add it back. 2 to go. Interest expense. 246 on the balance sheet. What do we see? Interest payable, decrease by 12. Decrease in a liability, deduct. Finally, income tax expense, all we see on the balance sheet. As I say, we have no deferred tax here. All we see on the balance sheet is income tax payable. That increased by 5, an increase in a liability, add it back. So all of these movements in our operating assets, from accounts receivable all the way through to income tax payable, are exactly the same adjustments as we made in the direct method. The difference with the indirect, you have to first adjust for your non-cash items, because we have every line of the income statement wrapped up in that 2210, all the lines we need and the non-cash that we don't. Gets us down to net cash provided by operating activities of 2606. Quick audit of the balance sheet just to make sure we got everything. We did all of these. That's just a subtotal. We did all of these. What we're missing, we didn't make any adjustments for land, buildings, equipment, accumulated depreciation. Well, that's fine, because those cash flows go through CFI. Indirect, done. Now, just for fun, I really need this, but given we went through the direct line by line and you didn't see it all kind of come together in a blaze of glory, I've just put everything we did on here. I'm not going to go through it all. Feel free to pause the video and just have a look. It's the exact same example. These are all of the direct cash flows we worked through slide by slide, if you will, painfully. And it's just there to gather them all together and show you CFO is 2606. Exactly the same as it was under the indirect method. These are just two different ways of presenting the same information. Either way you cut it, CFO is 2606. Either you disclose it directly like this, line by line cash flows, or you reconcile net income down to CFO. Okay, I think that's really the kind of beating heart of this module done. We've got a little LOS in here now that says demonstrate the conversion of cash flows from the indirect to the direct method. But to be honest, if you can do the direct and you can do the indirect like we just did, this LOS will give you no trouble whatsoever. The point it's just trying to make is this. Even if you are presented with an indirect cash flow, you have the skills as an analyst to turn it into a direct. And again, just to point out, this is only relevant to CFO. There are 3 steps. Number 1, disaggregate net income into revenues and expenses. So split them out. 2, remove non-operating. So anything that shouldn't be CFO and non-cash items. We've done that already. And 3, convert accruals-based revenue and expenses into cash flows by adjusting for changes in working capital amounts. Here is our income statement again from the example we've been working through. Let's try and follow these steps. Number 1, disaggregate net income into revenues and expenses. Well, can we find our revenues? Here is a revenue, 23,598. There's a cost, there's gross royalty, cost, expense, profit, costs. Gain on sale of equipment. They're calling that revenue, it's income, 205. So we'll add these two together. 23598 and 205, 23,803. Everything else in there is expenses. So gross profit is a subtotal. Total operating is a subtotal. So what we need to do is take these expenses, interest and tax, and add all of those together, which are in here, to get my total expenses. And just to check you've got it right, your revenues less expenses should give you 2210 net income. Number 2, remove non-cash items. Are there any non-cash items in here? Well, we mentioned this earlier on. In expenses, depreciation expense, is non-cash. So we're going to remove it. We look like we've got an outflow of 21,593. Add back the 1052. You've got 2541. Revenues. We have in here the revenue, okay, and gain on sale of equipment. That's non-cash. Remove that from your revenue. You get back to 23,598. It's a fairly simplistic example. Step 3. Well, step 3 is to put the cash flow together using the direct method. Now read number 3 again. Convert accruals-based revenue and expenses into cash flows by adjusting for changes in working capital. So for revenue, go and adjust for accounts payable. So this summarizes what we did in the indirect and direct method and just pulls it together on one page. It's nothing new or exciting. It just says, look, you can easily move from one format to the other if you understand how we're getting to these cash flows. And with that, we move on. And when I say move on, we move backwards. We're going to revisit, describe the steps in the preparation of direct and indirect cash flow statements, including how cash flows can be computed using income statement and balance sheet data. Why are we going backwards again? Well, we finished all of the CFO elements now. We did direct CFO, indirect CFO, and the conversion. Now we're going to move down and look at CFI and CFF. No direct or indirect method for these two, but we still need to know how to prepare them. Let's start with CFI, cash flows from investing activities. The most common components, what you're likely to see, are cash flows from the purchase and the sale of PPE. Could be intangibles as well. In practice, any investments that you're buying or selling. I say any, just be a little bit careful. If buying and selling investments, I'll just deliberately use a vague term, investments, is your business. If that's what you do, then the flow should be in CFO. But anything else, or any other companies, I should say, it will go through CFI. But most commonly, and certainly for the examples we'll set up here, we're going to look at the purchase and sale of PPE. Purchase, any cash spent on additions is an outflow in investing activities, and sale, the cash received from disposals, selling your PPE, is an inflow in investing activities. Now, can we just pick that information up straight from the accounts? Well, yes and no. We can by using disclosures, but be careful. This is our issue. Net PPE on the balance sheet also changes, as well as changing due to additions and disposals, also changes due to depreciation. So if you didn't buy any assets during the year and you didn't sell any assets during the year, there is no cash flow from investing. Your net PPE figure will still change because the assets will be depreciated. But as we know, that depreciation is not a cash flow. We're going to have to deal with that. Easiest situation is if historic cost and depreciation are given separately. And that happens quite a lot. In the example we saw earlier, you saw them separately. You might not have noticed it because we were focusing on CFO, but we had the cost and the accumulated depreciation. If that's the case, let's proceed as in yellow here. On the left, historic cost. Go to the balance sheet and find the historic cost of PPE at the start of the year. Go to the balance sheet and find historic cost at the end of the year. Two reasons why historic cost may have changed. You may have made additions and you may have made disposals. If you've made a disposal, you need to find the historic cost. So for working with historic cost, make sure the disposal's at historic cost. So if you made a disposal, deduct that historic cost. You'll have to find that in the disclosure somewhere in the footnotes. And that would leave us what came in through additions, which, unless we're told otherwise, we presume is cash. On the right-hand side, accumulated depreciation. See the total balance at the start of the year on the balance sheet and at the end. Reason it's moved. Depreciation expense you can pick up from the income statement. If it's not separately shown on the income statement, again in the disclosures in the footnotes. And balance back to the accumulated depreciation of disposals. Why would we need that? Well, if we know the historic cost of disposals and we know the accumulated depreciation of my disposals, I can work out the net book value of my disposal. Why do I need that? To work out my gain or loss on sale, as we'll see on the next page. So if you've got historic cost and accumulated depreciation separated out, that's what you're doing. If you've only got net PPE, go to the balance sheet, find your opening balance of net PPE, your ending balance. Depreciation expense you can pick up from the income statement will have reduced it. Didn't need to worry about that over here because it was historic cost. Here, we're at net PPE. It will have been reduced by depreciation expense. Net book value of disposals will have reduced it. And that might be in your disclosure somewhere. Here, we were working with historic cost because we're working net here. Make sure you're using the net book value, the net figure for your disposal. That would leave you, once again with additions, which we assume is cash. It's a little puzzle to solve. Once you've been through the PPE reading, you're a bit more familiar with how PPE works. Should sit a little bit nicer, but let's do an example. And it's using the same set of accounts that we've been following through this module. Let's first of all separate, because we are given the information separately here. So in 2017, 2018, you can see for land, buildings, and equipment, these three figures here represent costs. And then separately, we're given accumulated depreciation. So we can work separately. Then we have the income statement, which is going to be useful for a couple of things. First of all, depreciation expense. And secondly, a gain on sale of equipment. So let's have a look at what we can work out. Starting by working separately. What is the beginning historic cost of PPE? If we add these three together at the start of the year, 2017, 510, 3688, 555, you get 12,745. Now, I'd usually expect to balance back to additions, but look what we've got here. We are told, little asterisks here, during 2018, Acme purchased new equipment for a total cost of 1,300. No items impacted retained earnings other than net income and dividends. Okay. So we are given our cash additions. That was easy enough. 1,300. We can then work out our ending historic cost, 510, 3618, 8798, 12,988. That gives us a missing figure, which is the historic cost of disposals, which must be 1057. Bank that number. Put it in your head. Depreciation. Beginning of the year depreciation accumulated on the balance sheet of 2891. There it is. At the end of the year 2018, 3433. No, 3443. 3443. And from the income statement, we charge depreciation expense of 1052. Missing figure. Work back, it must be 500. That's the accumulated depreciation that disappeared from the accounts. Why did it disappear? It was on an asset that we sold. Looks like the asset that we sold had a cost of 1057 and accumulated depreciation of 500. Now that's doing it separately. At the bottom, if you prefer to work net, you could. It's a little bit quicker here. At the start of the year, 9854, my opening balance net. So cost less accumulated depreciation. At the end of the year, it's 9545. There it is, 9545. We know our additions were 1300. We were gifted that. And we know from the income statement that depreciation expense was 1052. The only missing figure we have there is the net book value, because we're working net here, of disposals. Balance back using these figures, that must be 557, which is encouraging because that's what we figured out up here. 1057 less 500, 557. Now that's all very neat, but what was the point of that exercise? You may be shouting at the screen. We needed this figure. Sometimes you're balancing to this figure to work out what our cash spent on additions was. In this case, we worked back to the net book value of disposals. Why? Because that will allow us to calculate the cash received from the sale of equipment. We know in this example the cash we paid for purchases. We were gifted additions of 1300. But what we didn't know was the cash received from sale. So I've just written out, we've just carried forward here exactly what we did on the previous page. We worked out that the net book value of assets I disposed of was 557. I need to turn that into cash proceeds. How do I do it? I need the gain on sale from the income statement. Net book value of disposal was 557. The gain on sale from the income statement was 205. How do I make a gain on sale? Well, it must be from selling an asset at a higher price. If I sold an asset of 557 and managed to make a gain of 205, I must have sold it for 205 plus 557, $762. There is my cash received from sale. I know my cash paid for purchase was 1300. My net cash used for investing activities, CFI if you will, is 538. Finally, for this LOS, CFF, cash flows from financing activities. Shows cash flows from sources of finance, debt and equity, and a dividends paid. That's the one that might give you a little bit of entertainment. Now, I say and dividends paid, as we'll note in the final LOS, there is a choice under IFRS for dividends paid. We'll mention it later on, but for the moment, let's assume it's there. Movements in debt and equity are straightforward. You just pick them from the balance sheet. Dividends paid is a little bit more fun, as I say, because we'll need to use net income and retained earnings. Let's look at debt and equity first of all. Here's the balance sheet from the same example we've been using all the way through. We have long-term debt. Missed out the headings here, but believe me, this is 2017 and 2018 as it's been all the way through. So we're going from 3575 to 3075. That is a decrease in long-term debt of 500. If long-term debt decreased, I've paid some off. So that's an outflow of 500. Unless I get any other information that this is some sort of amortized cost movement and so on, but I don't get that. I'm assuming I've just paid off debt of 500. It's an outflow. Common stock, 4,350 to 3,750. A decrease again of 600. We've reduced common stock, retired common stock. It's an outflow of 600. What we don't see is dividends. And you can't just go to the income statement and pick out dividends because they're not there. So how do we get it? Well, we use a little bit of accounting sleuthing. What we do have on the balance sheet is the movement in retained earnings. And remember I said at the very top of this learning module, there's only one time we'd be interested in the reconciliation of shareholders' equity, the statement of shareholders' equity, and checking out retained earnings and dividends, and it's here. because we know what moves retained earnings. You check the start of the year and you've got retained earnings of 2876. There it is, 2876. It will increase if you make net income. Now, I haven't brought the income statement in again, but it's the same example we've been using. From the income statement, net income was 2210. Yet, when we look at our ending retained earnings, it is only 3966. Something has gone missing. What is it? Well, obviously, it's the dividend. Add your beginning retained earnings to your net income. That's where you should be. If retained earnings is lower than that, it's because we've paid out a dividend. In this case, 1120. It's an outflow because it's a dividend paid. Those three together give you net cash used for not investing activities. That's a blunder. Financing activities, CFF, of 2220. And that is it. Obviously, we've been here a while. That's a long old exercise to work through. You're not obviously going to be asked in a multiple choice exam to prepare an entire cash flow statement. What this module is trying to do is get you to understand where the numbers come from so you can put it together. So you may be asked in the exam, to do the odd line here and there. But mostly what you're being asked to do is understand where the cash flows come from so you can start to use them in a useful way. And that's what we'll start to do in Cash Flows Part 2. But before we get there, we've got one final LOS to look at, and that's just a little one-screener. Contrast cash flow statements prepared under International Financial Reporting Standards, IFRS, and US Generally Accepted Accounting Principles, US GAAP. Well, here it is. A beautiful summary, even if I do say so myself. US GAAP versus IFRS. There are differences. Let's start with US GAAP. Interest received, interest paid, dividends received, all CFO. Dividends paid, as we just saw, CFF. IFRS. Choice. That causes grief for you as an analyst because it means you're going to have to check where things are. First of all, interest received. Could be CFO. If it is, hooray, consistency. Or CFI. Interest paid. Could be CFO. Hooray. Or CFF. Dividends received. Could be CFO. Hooray. Or CFI. Dividends paid. Could be CFO. Boo. Or CFF. Hooray. So there's a chance it's consistent, but there's a chance it's not. What's the logic here? Well, to be fair to IFRS, what they're saying is this. If you have received interest, what have you done? How do you receive interest? You receive interest by investing in things. You receive dividends by investing in things. If you're paying interest, it's because you raised finance. If you're paying dividends, you raised finance. And to be fair, US GAAP agrees with that. So there is a method to their madness. But if they believe that is the best way of showing this, then stick to it. The worst thing you can do is give me a choice. It lets people or gives people the opportunity to manipulate. So you need to check this out as an analyst. Make sure you know whereabouts your interest and your dividends are in your cash flow statement. Two other items to look at. Bank overdrafts under US GAAP is part of cash. So all it's saying here is if you has, let's say, a positive cash balance of 700 and an overdraft in the bank, so your bank balance is negative in another account of 200, well, your cash balance that we're going to reconcile to is 500. IFRS takes a different approach. IFRS would say, no, the cash balance we're going to get back to is 700. Your bank overdraft, that 200, is part of CFF. We'll treat it as a cash movement. Taxes paid, all CFO under US GAAP. under IFRS might be CFO, but you have the choice of allocating taxes to its source. So if you can directly attribute tax to an investing flow or directly attribute tax to a financing flow, you take tax to CFI or CFF. So once again, maybe slight differences between US and international statements. Formats, not too much fun here. US GAAP, direct or indirect. Direct is encouraged. Please use direct. We'd love it if you use direct. We've already said early on, nobody uses direct. But a reconciliation of net income to CFO must be provided in either case. IFRS doesn't say that, it just says direct or indirect. Direct again is encouraged. Encouragement doesn't work. Standards work, rules work, encouragement does not. Most people use indirect. And that's it. As I say, a bit of a slog, lot to get through, but it's very, very logical. If you work that through 2 or 3 times, that entire income statement balance sheet example, it will just become second nature, and it will make analyzing statements of cash flows too much more fun. That's where the entertainment is. That's what we're going to use out in the real world, the analysis.